I'm speaking with Leo Haviland, and our topic is commodity markets. Leo, let's talk about commodities. What are the trends right now, and what's the outlook for commodities in general?
Well, taking the S&P Goldman Sachs commodity index as an indicator for the commodities marketplace in general, commodities have been in a bear trend since the spring of 2011, as have emerging marketplaces in general. So that bear movement in commodities has carried over into 2014. You even see it in petroleum marketplaces, which have been edging down as well. And that outlook, however, of course, ties to the China story, where weaker commodities, given China's big role in the world economy and in commodities in general, fit. So weak commodities, weak China, sluggish world economy in general is a story.
Commodities are tied to the world's growth story in general, and China in particular. So if you see China declining, what does that mean for commodities as a whole?
They will weaken despite the best efforts of the money printers and the central banks to generate inflation, which of course would help commodities to rise. So a weak world economy, weaker commodities prices. That's what happened during the financial crisis of 2007 to 2009.
Let's talk about the oil market, petroleum supply and demand, inventory levels. What do you see ahead?
Currently, taking the International Energy Agency's estimates as guideline for inventories, worldwide industrial inventories seem adequate. However, if one looks at United States oil inventories, overall they seem to be at least 4 to 5 days above average. So on the U.S. scene, it looks as if higher inventories will continue to place pressure on crude oil and refined product prices.
Okay, let's turn our attention to liquefied natural gas here in the U.S. and the chance that America will be exporting that liquefied natural gas in greater quantities.
On the second question, Scott, you've raised a wonderful political issue. Many hope that the United States will export natural gas soon because that will mean great revenues for the United States. Some politicians say that it will help to solve the burden of the world on the Russian bear, and perhaps we can get it over to Europe and help to solve the Ukraine problem. However, we're not going to have any exports at all until late 2015 at the earliest. So that won't be a big solution for either of those. And second, the output probably won't be even reasonably substantial until 2017. So liquefied natural gas exports, although they will be important, don't have a significant influence on supply demand now. As for U.S. supply demand generally, inventories ended this winter at near record low levels of about 11.5 days coverage, and the likelihood is that inventories will remain well below average at least through the late October period, when inventories then start to become drawn down during winter. So the U.S. gas situation is tight.
Leo, let's talk about international conditions and how these might affect oil prices. I'm talking about governmental flare-ups, rebellions, that sort of thing. What does the petroleum market expect in that regard in 2014?
Many problems have already rushed on scene, as you know, Scott. Libya's been a problem. Syria's a problem. However, the big producers, like Russia, don't look like they're going to stop producing. The Ukraine has captured many headlines. One should ask, why should the United States care about what's happening in the Ukraine? We have no major economic ties to Ukraine, first of all. Second, the Russians have long had the Ukraine and Crimea as a part within their sphere of influence. And third, why shouldn't the Russians be somewhat concerned about encirclement by NATO? And lastly, it's highly unlikely that Russia is going to be invading the NATO countries. The main issue of the Ukraine is the gas pipeline into Western Europe. Should there be an interruption of that gas pipeline, either by the Ukrainians themselves or by the Russians cutting off the gas, that would have economic consequences for Western Europe. So that is something to be concerned about.
The economic consequences of the failure to make an agreement between Israel and Palestine?
They may be severe for the Palestinians, but to the rest of the world, it will not matter at all.
Let's talk about the Arab Spring, the larger picture across the Muslim world, and the economic consequences of that.
Well, the Arab Spring, in part, could be viewed as, in some respects, as an Arab nightmare, but that may depend on country by country. The economic consequences thus far have been minimal. Saudi Arabian oil production, which is one of the key economic aspects of that world, continues to be substantial. And despite the dreadful challenges to democracy and numerous human rights violations, the economic consequences of the Arab Spring have tended to be minor. There was, of course, the interruption and still continued blockage of Libyan production, but the Saudis have made up for that.
Let's talk about Iran and the nuclear negotiations there.
It seems, although many might disagree with that, Scott, that there is an effort on both the Iranians and the negotiating nations to reach an agreement whereby the Iranian nuclear risk will not be a problem. In any event, that decision won't reach its next key stage until sometime in July. The only way the Iranian situation will become a major problem for the world economy would be if Iran happened to launch a nuclear attack, or if there were an attack by the US and or Israel on the Iranian installations. And I don't see either of those happening, at least for the next several months, if ever.
Mm-hmm. The upside potential of a satisfactory negotiation on the nuclear question is pretty great, isn't it? I mean, this is a big market.
Yes. Iran is a huge energy producer, and should it have access so that it could sell the amount of petroleum it likes, it would be a very bearish sign for petroleum.
Let's talk about Iraq, the sectarian conflict that seems to be firing up again there, and also the related conflict in Syria next door. Any economic consequences of these?
Thus far, there have not been substantial consequences other than, of course, for the Syrian nation itself, and to a lesser extent on Iraq. Iraqi oil production after fits and starts has increased substantially over the past few years, so their political divisions have not stopped earnings from oil. And admittedly, though, there are ongoing sectarian problems in Iraq, whether it's the Kurds, the Shiites, and the Sunnis, or how they interact, such that there is some risk of supply interruption, but not a substantial one. The real question is, how quickly could Iraqi production be increased should political stability eventually emerge?
Let's talk about what are called alternative investors in the commodity playground. People who buy and hold. They're not exactly producers, they're not exactly the buyers of the oil, they're people in between, and there are more and more of them. What are the economic consequences of their participation?
One key consequence of their involvement, Scott, has been to raise the overall price of the marketplaces in which they invest. In the agricultural world, for which there are statistics about these buy and hold investors, they have averaged between 20 to 25% of the total open interest. So that's demand which tends ultimately to reduce free supply of the commodities to some extent. And as you know, reduced supply tends to mean higher prices. So the consumers, say here in the United States, pay more. And take petroleum as an example, the oil companies that hold big reserves benefit from it. And the big oil producers, including those overseas, benefit from it. So we can thank the alternative investment mantra and selling effort for taking money out of consumer pockets.
Mm-hmm.